Nvidia stock is the topic of today's presentation. In particular, we're going to talk about alternatives to Nvidia stock, and that would be applicable to anyone that's not currently holding shares of NVDA. So we happen to be in the camp that are holding shares, and in order to understand why, I took a look back at this piece that we wrote back in 2016, which here talks about the artificial intelligence stock that rocked Wall Street. This was written weeks after we had established our own position in Nvidia. And the comment we made here, Nvidia looks like a great $45 billion picks and shovels play on AI computer chips, and it may be the closest thing there is to a pure play artificial intelligence stock there is. So I'll put a link to this piece in the description of this video. And that blue arrow points to when we started accumulating. And I think several years ago, when you see that spike there, we had started selling because we have a rule that says we don't allow shares we hold to exceed 10% of our total portfolio. And we were at one point trimming Nvidia for months. So we've harvested a lot of those gains. And back when we decided to take that position, Nvidia was only starting to grow their data center revenues. Here you can see on the left where the 2015 revenues reflect data center revenues of about $339 million, and that was growth year over year of 183%. That's when we noticed that strong growth, and since then, data center has become a dominant source of NVIDIA's revenues, accounting for more than 60% of total revenues. The chart on the right shows that growth, and in May of 2022, you see the title there from the next platform. It says, Data Center becomes NVIDIA's largest business. Now, one problem that they've encountered recently is that the growth of data center revenues have flatlined. Here you can see that data center revenues over time, along with that percent of total in the blue line. Basically, 5 years ago, data center revenues were about 7% of total revenues for NVIDIA. Today, they're 60%. This was a case of skating to where the puck will be, but that doesn't always work out. One example of that would be Teradyne, and looking to them as a player in industrial robotics. So one thing to note here is that NVIDIA began from a leadership position, and they've been able to maintain that over time. So they are said to command around 80% market share for GPUs in AI workloads. Now, when you look at this revenue growth problem, you'll note that it extends across the other major GPU provider, which is AMD, seen on the right here. You can see how their revenues have been lagging. A cursory look here shows that NVIDIA on the left is also far more profitable, and that makes sense. If you're trying to catch up to the leader, you have to spend a lot more money on R&D. Now, this is an interesting chart that we did. This was back in 2017, and it was comparing AMD to NVIDIA. You can see here that NVIDIA's market cap is already up to, it looks like, somewhere around 80 million or billion, compared to AMD at 11 billion. We did a revenue comparison looking at profitability. But what was interesting here is how much NVIDIA talked about AI in their investor deck, all over their homepage, in the 10K, references to AI and deep learning. Look along the bottom of that chart there. How much NVIDIA was focusing on communicating those messages to the investor community as opposed to AMD. Well, that's probably changed a lot. And back in 2017, AMD was trying to respond to that. Here you can see a screenshot we took of their one of their investor relations pages that shows they very quickly tried to throw something up there, machine learning. So since then, AMD has done a fairly good job of growing their data center segment. So if you look at these two firms, they're starting to look quite similar in terms of AMD starting to try to copy NVIDIA in terms of how they segment the revenues and whatnot. So right now you're getting about 24% exposure to data center from AMD. That's seen on the right there, revenues of $1.3 billion. You'll notice they're flat year over year. That makes sense, right? Because NVIDIA's were as well. So is AMD another case of skating to where the puck will be? Well, it's certainly a more fairly valued way to play the growth of GPUs. And pundits expect there to be a lot of growth, mainly because of ChatGPT coming into the scene late last year. And here you can see we took this from Tom's Hardware. It's a good analysis on what sort of GPU usage ChatGPT is looking at. So they need to have around 30,000 units of GPUs, and there's the cost there, and that means NVIDIA is looking at an additional $300 million in revenues. And of course, you need to take into account discounts and stuff like that. But there's this belief that generative AI and the money that's being thrown into such startups sight unseen means that there's going to be a lot of hardware purchased, and analysts are pushing up the forecasts for NVIDIA based on these projections, which is what they are, and it remains to be seen what NVIDIA is actually able to accomplish by the end of this year. We wrote about that in our last piece on NVIDIA. I'll put the link to that in the description of this video. One thing you'll note that NVIDIA stresses in their investor deck is just how big the opportunity is for what they're doing. Here you can see they describe it as $1 trillion, and we had tweeted this out. By the way, we're on Twitter, so go follow us on Twitter at Nanalyze Tweets if you'd like to be caught up to what we're tweeting. And here you can see where we tweeted this out, a $600 billion TAM, which was in another deck that we had looked at, and they've captured less than 5% of that opportunity, and even if TAM is half of what they estimated, there's still plenty of upside. That attracted a lot of naysayers, and rightfully so. These are huge numbers. $1 trillion is about where McKinsey expects the entire semiconductor industry to be by 2030. So NVIDIA is certainly exaggerating their opportunity, but when it comes to valuation, you can see that that's had some positive effect. Of course, from the company's perspective, a higher share price means that they can do more. It's better for the firm. And here, when you look at valuing NVIDIA and AMD, one thing to note is that leaders usually remain leaders. So you have NVIDIA and AMD commanding nearly all the market for GPUs. And when you look at exposure, though, as we said, NVIDIA with 60% data center exposure, AMD at 24%. Perhaps that helps explain the valuation gap, which you can see here. This is simple valuation ratio we use internally. It's just market cap divided by annualized revenues. Price to revenue ratio is also another way to describe this, except it depends on whether you're using annual revenues from the prior year or annualized as we do. Now, when you look at the entire semiconductor industry in 2021, that was worth about $590 billion. You can see that broken down here in this chart from McKinsey. And then you can see the projections there out to 2030 where it breaches $1 trillion. Almost 70% of this expected growth or predicted growth is to be driven by automotive, computation and data storage. That's where AI would fall under, and wireless. Now, when you look at the semiconductor industry as a way to play AI, one way you can look at it is that everything's an AI chip. So, you know that famous quote, once it works, nobody calls it AI anymore. Well, the other quote might be, if a chip runs an AI algorithm, is it an AI chip? And they're typically describing the AI opportunity into 4 buckets: mobile data center, which is what you see coming from NVIDIA and AMD, automotive, and IoT edge. Now, the 2 major use cases for AI right now that would require AI-specific hardware are training and inference. And here's a piece that we wrote several years back that looked at how AI chips are changing the semiconductor industry. And training is the process of showing the AI algo cat pictures. When the algo switches from being trained to making predictions about whether or not a photo contains a cat, it moves from training to inference. So that's exactly what we train AI algorithms to do, is to deduce or conclude information from evidence and reasoning rather than from explicit statement. So when we look at usages of various types of AI chips, you have graphics processing units, GPUs, what we talked about, coming from NVIDIA and AMD, used primarily for training AI algorithms. You have field programmable gate array, FPGA chips, Intel and Xilinx. These are used primarily for inference. So AMD purchased Xilinx, that's worth noting. Then you have ASICs, and these are used for both training and inference. So one concern here when you look at, well, some major semiconductor player might displace NVIDIA's market share. Well, you also need to look at what their major customers are doing. So all three hyperscalers, Microsoft, Google, and Amazon, are building or have built their own data center chips. So competition may not come from the semiconductor industry or from the many well-funded AI chip startups. It can also come from customers. So investing in a semiconductor ETF, we don't believe, is a viable way to get exposure to AI chips because it's too diluted, and also it ignores some of these competitive pressures that come from outside the industry. Now, we did find a firm that allows you to benefit. In fact, they're selling to a lot of the companies that aren't semiconductor firms that are developing chips in automotive and whatnot. This is a company that we first covered about 3 years ago in the title of an article here, Invest in Many Types of AI Chips with One Stock. And then more recently, this was yesterday, we published a piece that also references this firm. It's titled Investing in AI with Semiconductor Stocks. So this firm has been focusing on AI for half a decade. Their first generation AI could explore 10 to the power of 90,000 possible ways to place and route a chip. To put that into perspective, the algo that beat that Go world champion was doing 10 to the 360th power. This is doing 10 to the power of 90,000. So it's remarkable. And that was the first generation. They're now on the second, or they may even be on the third. And today, over 100 chips have been designed by their AI algorithms, realizing up to a 25% drop in power requirements and a 3 times productivity increase for engineers. So getting chips out faster is certainly a good thing. And they're also paving the way to personalization, which could allow for 1,000 times performance and efficiency improvements. This is according to this firm, going down that road to personalization. So that sort of efficiency moves your processing power closer to the edge, out into the IoT world. So we like this firm. If we weren't holding Nvidia, we'd probably go long. Our conclusion would be that Nvidia, of course, as everybody would probably argue, is overvalued. And this isn't the first time it's been overvalued based on pundits seeing the potential for the firm. AMD is certainly a more fairly valued way to play GPU growth, and that's for a reason. Investing in semiconductors dilutes exposure too much, and we happen to like this firm that we talked about, which is you can read those two pieces that I've linked to in the description of this video on this firm. And they're using AI to build better chips for all major chip makers and, of course, entities outside of the semiconductor world that are trying to build their own chips. Now, I've put up another video here for you to watch on the left. Before you click that, please click the Nanalyze logo here on the right. Subscribe to our channel, support our work. Thanks so much for taking the time to watch this today.